In the fall of 2021, the premium salad chain Sweetgreen IPO'd to much fanfare. On the first day of trading, its share price almost doubled, valuing the company at more than $5 billion. Sweetgreen promised to revolutionize fast food by focusing on healthy options and locally grown ingredients, a sharp contrast from the ultra-processed slop served by the legacy fast food chains. The company had grand ambitions to expand rapidly. Sweetgreen's CEO even said that he wanted the chain to become the McDonald's for the next generation. Despite their rapid growth, Sweetgreen has always reported operating losses. Investors started to question the viability of selling overpriced salads. By March of 2023, Sweetgreen's share price had declined by almost 90%, putting them on the brink of penny stock status. It looked like they would join the trash heap of overhyped companies that went public in 2021. But against all odds, the company has made a comeback, with the share price increasing fivefold from the lows. In this video, we'll look at the rise of Sweetgreen, why they've struggled with profitability, and why Wall Street now believes they're on the brink of a turnaround. Running a large restaurant franchise is incredibly complicated. Companies like Sweetgreen employ scores of data analysts to track everything from their store sales to their supply chain. With data analysis tools and techniques always advancing, you need to constantly be learning if you want to stay on top. Today's sponsor, Brilliant, provides the best way to do just that. Brilliant is a learning platform offering courses in data analysis, programming, math, and more. Their first principles approach helps you build understanding from the ground up. Each lesson is filled with hands-on problem solving that lets you play with concepts, a method proven to be 6 times more effective than watching lecture videos. For example, their data analysis course teaches data visualizations, algorithms, regression models, and more from the beginner to advanced stages. You'll learn how to parse and visualize massive datasets, including real datasets from sources like Airbnb, Spotify, Starbucks, and more. With Brilliant, you can become a little bit more knowledgeable each day. It's like the opposite of mindless scrolling. To try everything Brilliant has to offer for free for a full 30 days, visit brilliant.org/wallstreetmillennial or scan the QR code on screen. Or you can click on the link in the description. You will also get 20% off an annual premium subscription. And now back to the video. Sweetgreen was founded in 2006 by 3 Georgetown students in the Washington, D.C. area. The idea of Sweetgreen was to provide a healthy alternative to existing fast food chains, which mainly served ultra-processed junk. From the beginning, they sourced their ingredients directly from local farmers. This stands in contrast to most restaurants that rely on large food distributors. By sourcing directly from farmers, Sweetgreen claims it has more control of how the food is farmed, both from a quality and sustainability perspective. Their first store was a big success. Around 2013, they started raising tens of millions of dollars from venture capitalists. That's when they started to expand rapidly. They opened up new restaurants, focusing mainly on large cities. As of the time they IPO'd in 2021, their restaurants were concentrated mainly in Washington, D.C., New York, Boston, Chicago, San Francisco, and Los Angeles. The focus on large cities was no accident. As we discussed earlier, they source their ingredients from local farmers. This is often more expensive. Also, their salads are made from scratch within the restaurants themselves. This is in sharp contrast with most fast food restaurants, which perform much of the food preparation in central locations. While Sweetgreen's method improves the freshness of their salads, it is also less efficient, requiring more employees in the store, thereby driving up costs. These high costs oblige Sweetgreen to charge high prices for its salads. That's why they focus on top-tier cities with large populations of young, hip professionals who are willing to spend $15 on a salad. Sweetgreen is very popular among so-called finance pros and tech pros, people who work high-powered jobs with long hours. Not having time to pack their own lunch, overpriced salad at Sweetgreen is their only option for a healthy meal. Their salads are pretty substantial, with most of them having meat or some other form of protein. They are designed to be a full meal. With that being said, most of them are only around 500 calories. Such a small meal is really only suitable for lunch, not dinner. Most customers order Sweetgreen for lunch, often bringing the salad back to their office to eat. Sweetgreen developed an app where you can order food to your home or office, or pick it up in store. The digital sales channel has been highly effective. As of 2024, almost 1/3 of Sweetgreen's sales were through their app. Another 25% comes from third-party delivery platforms such as DoorDash and Uber Eats. So in total, more than half of their sales are done through some kind of app. Sweetgreen does not employ any of its own delivery drivers. Instead, they partner with DoorDash. So when you order delivery through the Sweetgreen app, a DoorDash driver will bring it to your home. In November of 2021, Sweetgreen raised $364 million in its initial public offering. The IPO was initially a huge success. On the first day, the share price surged 76% to $52, valuing the chain at over $5 billion. As the company reopened after COVID, same-store sales were surging back from their pandemic lows. At the same time, the chain was still only operating in a few major cities, mostly in the Northeast and California. Wall Street analysts projected that the chain could grow massively over the coming years by expanding into the middle of the country. Flush with cash from the IPO, that's exactly what Sweetgreen started to do. In the first quarter of 2021, they had 120 locations. By the end of 2021, this had increased to 141. By the end of 2022, this had increased to 177. Sweetgreen has incurred operating losses since its inception, relying on venture capital investment to sustain itself. They claim that most of their stores are already profitable. They're just not profitable enough to cover corporate overhead. The plan was to open up enough restaurants such that the restaurant level profits will become enough to cover their corporate overhead. Restaurant level profit is defined as revenue minus the cost of raw materials, wages paid to frontline employees, occupancy costs, etc. It's the profitability of the restaurant itself. In 2022, Sweetgreen generated $69 million of restaurant level profit, or approximately $390,000 per restaurant. But that same year, they incurred $261 million of corporate overhead and other operating expenses. This resulted in an operating loss of $192 million. This begs the question, why does a salad chain need so much corporate overhead? Remember that Sweetgreen sources its produce from a large number of independent farmers. This makes its supply chain far more complex than most restaurants, which source from a small number of national distributors. Every time they expand to a new city or region, they need to set up new relationships with new farmers. This is a huge administrative burden, requiring armies of white-collar employees to manage. Despite strong revenue growth, Sweetgreen's operating losses widened throughout 2022, as their operating expenses continued to expand. At the current rate, Sweetgreen would need to open up many hundreds of new locations to break even. But it's unclear how much appetite there is for overpriced salads outside of a few major cities on the coasts. To get a sense of how expensive Sweetgreen's menu is, I compared the prices of meals at Sweetgreen, Chipotle, and McDonald's all in central Manhattan. Sweetgreen salads cost around $15. Chipotle burritos also cost around $15. A McDonald's combo meal costs about $14. So they are all priced pretty similarly to each other. However, there's a huge difference in terms of dollars per calorie. The Sweetgreen salads only have around 500 to 600 calories. Chipotle has around 1,000 calories, although this can vary widely based on what options you get. The McDonald's meals also have around 1,000 calories. So at Sweetgreen, you're only getting around 33 calories per dollar. At Chipotle and McDonald's, you're getting around 67 calories per dollar, more than double the value of Sweetgreen. It makes sense that McDonald's is cheaper than Sweetgreen. Most McDonald's food is prepared at central facilities, making them cheap and easy to heat up at restaurants. The more interesting comparison is Chipotle. Chipotle is similar to Sweetgreen in that the food is cooked and prepared on-site. So how is it the case that Chipotle can provide roughly double the calories per dollar? Most of the volume of a Chipotle burrito is made of rice and beans, which are cheap and easy to transport. And because the meat is either chopped up or shredded, they can use low-quality cuts. The high price of Sweetgreen is acceptable in places like New York and Washington, D.C., where there exists a large supply of finance bros, tech bros, etc. If they want to expand to smaller cities in the middle of the country, there may not be enough customers willing to pay $15 for a salad. By the end of 2022, Wall Street started to worry that Sweetgreen's appeal was too niche to ever become a nationally successful chain. Analysts rushed to lower their price targets, and the stock fell to below $7 by March of 2023. This was an almost 90% decline from the peak. Things were not looking good for the company. If they wanted to survive for much longer, something needed to change. To their credit, Sweetgreen recognized their problems, and over the past year, they made a number of important changes, which have put them in a much better position. In the fall of last year, they launched a new product offering called Protein Plates. While they had experimented with this before, this was the first time they were rolled out nationally. These are meat and rice-based dishes with around 900 calories, almost double the calorie count of their salads. They're still a bit pricey at about $17 each, but they're filling enough to have for a dinner. This fulfills a much broader appeal than their salads, which were only suitable for lunch. This new menu is already bearing fruit. When the company went public back in 2021, they generated about $700,000 of revenue per restaurant per quarter. In the second quarter of 2024, this has increased to almost $800,000. The protein plates are probably less profitable than the salads. Meat costs significantly more than vegetables, and they only charge a couple dollars more. But the protein plates attract customers during dinner hours, when the restaurants were previously underutilized. This helps to absorb fixed labor and occupancy costs. Even if each protein plate is less profitable than each salad, total profit will still increase if you start selling more protein plates during times when you would otherwise be selling nothing. We can already see this in the numbers. Back in 2021, Sweetgreen's restaurant level profit margins were below 15%. Today, they've increased to above 20% of revenue. The protein plates should have a broader appeal than salad, which should help them as they gradually expand to smaller cities and suburbs. Over the past year or so, they've expanded beyond the coast by opening up restaurants in Texas, Michigan, and some other Midwestern states. In the most recent quarter, Sweetgreen generated $185 million of revenue, a 21% increase compared to the prior year. Their operating losses also improved from negative $31 million to negative $16 million. So while they're still not profitable, the numbers are certainly moving in the right direction. In the long term, Sweetgreen hopes to reduce costs with automation. In 2021, they acquired a robotics startup called Spice. They created a robot which can automatically input the ingredients based on the customer's order. They call this the Infinite Kitchen and are currently beta testing it in 2 locations. The company claims that the Infinite Kitchen robot reduces the number of staff they need by 1/3. This is still in the early stages. While the robot does decrease the number of staff, what happens when it breaks down or needs maintenance? You may be replacing very cheap fast food labor with very expensive technician visits. We'll have to keep our eyes on the Infinite Kitchens and see what happens going forward. With all these positive developments, Wall Street once again turned bullish on the company. Since its trough in March of 2023, Sweetgreen's share price has increased more than 5-fold, giving it a market capitalization in excess of $4 billion. With all that being said, Sweetgreen is not out of the woods yet. While profitability has been improving, they still incurred an operating loss of almost $100 million over the past 12 months. The chain still only has 231 locations across the country. They still need to increase their store count massively before they have any hope of breaking even. While their new push into protein plates definitely broadens their appeal, they are still far more expensive than other fast food options on a per-calorie basis. While the company's future remains uncertain, at least now they have a fighting chance of survival. Alright guys, that wraps it up for this video. What do you think about Sweetgreen? Let us know in the comments section below. As always, thank you so much for watching and we'll see you in the next one. Wall Street Millennial, signing out.